Hello everyone, and welcome to your Glassnode video report for week 30, 2022. So what we're looking at today is a concept called conviction through Confluence. We're looking for all of the different on-chain and technical models that we have. What does it tell us about the current market structure? What does it tell us about the recent capitulation and actually flush out of investors? And then what does it tell us about the market moving forward, and where are some particular zones of interest? So after we've spent about a month in this consolidation range around the 20K zone, there's been a very significant shift in the ownership structure. We've seen a large amount of people, whether they're short, long-term speculators, flushed from the market. They've essentially capitulated out in two phases, first with Luna and then again on the 18th of June. Now, again, that doesn't mean that this is all over. We've still got some time and some process to go through here. But what we can start to look at is, what is the overall changing market structure? What does the ownership structure look like? What kind of statistical deviations have we seen? How far did the market stretch away from its fair value? We'll talk about this in some detail. We're going to see whether we actually get an impact in that long-term conviction. So we're looking at that long-term holders, bringing in the concept of Coindays to try and assess how much age has actually been flushed from the market. We're going to look at things like support and resistance zones, both on a technical and an on-chain standpoint. And again, what we're looking for here is confluence, where there's multiple models that are suggesting the same outcome. And then we're finally going to close with market momentum, looking at a couple of gradient oscillators to really assess over multiple time frames, what does market structure look like in terms of the momentum? Where is the overall shift in the market starting to move to? So as usual, please do give us a rate, a share, and a subscribe. It helps this channel get to more people, and hopefully you find this session useful and within our new dashboard format with some of the guidance that you can actually see on those side panels. So as always, starting with market structure, what we've seen is a continuation of what looks like a bear flag. We had a bit of a push up into the $24,000 realm, and we have since pulled back to about 20,000 at this point of recording. So what we're seeing is that the market is struggling to get that upside momentum. And this doesn't really surprise us when we see these very, very large sell-off events or rallies for that matter. We tend to get these periods of consolidation where the market is digesting that move and those coins are starting to change ownership. We're seeing hodlers come into the market. We're seeing other people getting flushed out. There's forced sellers. There's minor capitulation. There is a whole reshuffling of the Bitcoin ownership structure. And this is essentially the process that bear markets go through. And that's why they don't change overnight. It's why they take periods of months, sometimes years, to actually play out, because you're getting that reprocessing and digesting of very, very large and volatile moves. Now, what we're going to start this session with is looking at the recent price bounce and some of the, I guess, the leading indicators or things that we can essentially look at to suggest when such events like that are prone to happen. Now, the first one we're looking at is the Mayer multiple. Now, this is a ratio between price and the 200-day moving average. Now, why this is an important metric is that the 200-day is one of these long-term moving means. Lots and lots of investors and traders will look at it and just use it as a very simple proxy. When price is above, it's more bullish. When price is below, it's more bearish. So it generally tends to pick up. You can see here in the red, it forms resistance during a bear, and it typically forms support during the early phase of the bull. So generally speaking, when the market is above or below, it tends to stay there for an extended period of time. Now, the blue curve we have down the bottom here is a Mayer multiple times 0.55, or in other words, the market is trading at a 45% discount to the 200-day. Now, what you can see here is that it rarely touches it. There's March 2020, there's back here at the very bottom of November 2018, and here we are over a period of a couple of days from the 18th of June to about mid-month. So what we're seeing is that this is a very uncommon period of time. In fact, only 3% of Bitcoin's trading history has ever closed below that particular level. So what we're looking at is almost like a slingshot. Imagine it getting pulled back just that little bit too far, and there's only so far it can be pulled before it has to revert back towards the mean. So what we're looking for here is trying to stack the confluence of when you get these large deviations, very, very uncommon events that generally signal there's going to be some kind of reaction in the other direction. And what you'll note is that even in the most powerful bull markets, there are pullbacks, and in the most powerful bear markets, there are rallies. And this is what we're looking for, those periods of overextension in one particular direction. Now, the second model we can look at to try and describe this deviation is the MVRV. So to break this model down, the MV stands for market value, or market cap spot price. And the RV is then the realized cap or the realized price. Now, the realized price, we really consider that to be the average price of all coins in the system. It's the average price at which every coin in the Bitcoin supply last moved. Now, what we're looking at here is a 4-year Z-score. So this is a statistical model. What we're looking at is over the last 4 years, which captures both bull and bear, halving cycles, and we're not really comparing the current mature market back to 2011 and 2012. We're only considering more recent and more relevant history. So when we take a Z-score, what we're looking at is in terms of how many standard deviations away from the mean is it. So it's a tool that both normalizes the market structure, but also gives us a statistically meaningful, how probable is this to actually occur? Now, during our 18th of June sell-off, we actually reached the lowest level that we have seen in this oscillator. So over any 4-year period, this is the largest negative deviation that we have ever seen. Now, previous zones where we have the MVRV trading below 1, which means the market is on aggregate underwater on their position, is shown in these red zones. And you can see it also typically shows up towards the very, very late stage of bear markets when we've seen a very, very large negative deviation. So to have the largest on record alongside the Mayer multiple being at less than 3% probability, what we're starting to see is that the recent market structure down to 17,000 was a little bit outside the norm, right? What we've seen is a very, very large stretching of that slingshot. So it's only natural that there's a bit of a rebound back in the other direction. So during that process of the market actually selling down, what we generally see is a flush out of investors. Now, what we want to do here is actually probe and understand who those investors are. What was their character profile? Are they long or are they short-term holders? Now, one of the most powerful metrics that we have in on-chain analytics is the concept of Coindays. So what we're looking at here is every Bitcoin in the supply, 1 BTC will accumulate 1 coin day per day. Half a BTC will accumulate half a coin day per day. Now, when those coins are spent, we consider that coin days destroyed. And what we're looking at there, when we're measuring coin days destroyed, we're looking at how much time has been exiting the system. So if you want to think about this, when we have a very, very low amount of coin days, that generally signals that most of the coins that are moving are relatively young. Whereas if we're seeing a large amount, a very, very large print of coin days destroyed, that shows that older coins are coming back into the system. Long-term investors are either taking profits or taking heavy losses. They're exiting either in profit or they're panicking. So what this model here is looking at, these purple zones show when the amount of coin days destroyed in the last month is more than what was destroyed over the last year. So what we're looking at is the recent spending heavier in terms of the older coin days relative to the yearly average? And what you can see is it really highlights two zones. Strong bull markets, where basically this is the profit taking. These are older coins from the previous cycle coming back into circulation and taking profit on each rally. But you can also see that it shows up at capitulation events, March 2020, November 2018, back here in the bottom of 2015. So we can see there's really 2 times when these older investors on a very, very large scale activate their coins to start spending in a large degree. And that is during capitulation style events and bull markets. Now, naturally, what we care about here is actually the capitulation events. We're not so fussed about the bull market because sadly, we're not in one just yet. So that's where we move down to this combined model. We looked at the MVRV. Remember, when it's below 1, it signals that the market on average is underwater on their position. And we also looked at when that's a large statistical deviation to the downside. We also then explored when do we have a large amount of older hands panic selling. And that also tends to describe the very, very bottom of these capitulation style events. It's essentially a mass panic event. So let's combine those two concepts. When we have the MVRV in blue trading below 1, meaning the market on aggregate is underwater on their position, and we have these spikes in coin days destroyed, a large amount of coin day destruction in the recent month relative to the last year also tends to signify a capitulation. And that's what these green zones are picking up. Areas where we essentially have both the market underwater, increasing the probability of capitulation, and we have coin days destroyed spiking higher relative to their yearly average. And again, the yearly average, we've been in this bear market now for 7 months. So at least from the November all-time high, if you argue if it's from back in May 2021, we've been in it for over a year now. So what we're looking at is over that yearly period, we're really describing, is the spending by those older hands much, much larger relative to the bear market average? And what we're seeing here is that it actually is. And what we're seeing is a combination of both the market underwater and long-term spending. It adds increasing weight to the argument that we probably do have a capitulation that is in play and has already occurred. And then to really drill down on this, we're going to bring in the long-term holder concept. So remember, MVRV is an unspent ratio. We're looking at the coins they currently hold. How in profit are they on the coins that they currently hold on any particular cohort? When we look at a metric called SOPR, spent output profit ratio, in this case, only for the long-term holder cohort. These are people who've held their coins for 155 days or longer and are statistically the least likely to spend. So when they are spending, what the spent output profit ratio is picking up is what is the amount of profit or loss that the actual spending is realizing on their coins. Now, as you can imagine, the long-term holders, people have held their coins from the previous cycle. Whenever they spend, they're going to be in a large degree of profit. And see how this particular metric, this blue curve in these yellow zones, trades well above the value of 1. This means they're realizing a profit, and it keeps spiking all the way into the peak of a bull. Here's our 2020-21 phase, massive profits being realized. But note that as soon as the market collapses into a bear, whether it's 2018 or 2019, we see this rapid deterioration until their spending on average is actually below that cost basis. So what we're seeing is that this period through here, we're seeing that the spending of long-term holders on a monthly basis is much, much lower than it was the previous year. And you can see it tends to maintain these regimes all the way through to the start of the next bull phase. So you can see here, we went through this deep phase where long-term holders were cashing out less and less and less profit until we get to the very, very bottom. And then we get this recovery until the bull market starts, and then away we go back into profitable territory. So here we are in our current market cycle, which again, topped somewhere here in March 2021, collapsed down, and now their spending on a yearly average is much, much lower than their yearly average. So what we're now seeing is that we are deep within this full-scale bear market period. This has been about 420 days, and on average, we typically see 400 days, 380 days, so a fairly extensive period, and we have been in this phase for roughly a similar time to these previous bear cycles. Now, what we haven't yet seen is a recovery in this metric, showing that long-term holder spending is improving in profitability. So whilst we've seen that capitulation event, we've seen lots of investors, both recent who bought the top, people who bought recently, people who've held for a long time, there's been the flush out. But what we haven't yet seen is that recovery time, the duration element. We haven't seen that period of consolidation, actually proving that the market has a firm foundation down here at 20K. Remember, the market can do anything it wants to do. But what we're trying to do here is use previous cycles and investor behavior to compare what's gone on in the past and try and establish a case for what may be coming in the future. Now, in terms of some pricing models and zones of interest, what we tend to see with both on-chain and technical analysis, there's generally a lot of confluence between the two. We typically see that these models describe similar things. Now, what we're currently looking at is the 200-week moving average. We've been essentially oscillating around this or just below it for a period of time. You can see that in previous bears, it tends to catch the lows. We caught 2018, it caught March 2020, and here we are spending a little bit more time than usual below the 200-week. Now, this could perhaps suggest that there's been a bit of a change in market structure, probably a little bit more bearish. But it also could suggest that the market, like we saw above, is that little bit too stretched away from what is typical behavior. We don't know. We have to see how this plays out. But note that the market came up and it essentially broke above the 200-week, but has since pulled back. So what we're seeing is that the market is struggling to get above this particular level. Now, the 200-week moving average is hovering around 22,600. And generally speaking, when you do get these large-scale models that get broken, you may hear this in technical analysis, quite often broken support becomes resistance and vice versa. They tend to provide some kind of resistance on the way up. So this is certainly a level to be paying attention to. Now remember, this is a technical moving average. We can also then combine that with the on-chain moving averages or on-chain cost bases or different pricing models that we have. And we can see here, this orange curve is the realized price. Average price paid for every BTC in the supply. This blue curve is that same cost basis concept, the realized price, but only for long-term holders. And note here how both of these have actually converged at the same level. This is around 21,800 for the realized price and 22,200 for the long-term holder realized price. So what we have here is the 200 week at 22.6 and the realized and long-term holder realized. So we broke above it, but we've since come back down to really test this level. And you can see we've been consolidating around this for over a month now. So there's a period of interest or a zone of interest in terms of pricing levels is if we do break down convincingly below this, we can really see that it's performing that resistance chart, right? It's performing resistance on the market is struggling to actually get that momentum above it. And if we zoom in here in 2015, this is a great example. The realized price acted as resistance for multiple retests all the way through this bottom construction. So we do have precedent for it actually providing that resistance over time. And remember, back in 2015, this is before the realized price was even known about by the market. Now, there's another thing I want to highlight. This pink curve here is the short-term holder realized price. Now, what I really want to highlight, let's actually just zoom in on the last two bear cycles because this is instructive. Now, can you see here how the short-term holder realized price really dives much, much lower during that final capitulation phase? Here's 2018. Note how it dives significantly lower during that bear phase. What's going on? This is essentially describing that redistribution of supply. During the capitulation event, long-term holders, short-term holders, speculators, hodlers, miners, everybody reaches that final point of complete pain where they spend their coins, they change hands, somebody else comes in to buy those coins, and in most instances, they will be classified as a short-term holder. Even if they plan to become a long-term holder, some of those coins will be classified, or the majority of them will be initially classified as short-term holder coins. So this diving down of a lower cost basis is describing that event. Coins have been repriced from, in our instance, 50,000, 40,000, 60,000 down to 20,000. There's been a mass capitulation event that has essentially revalued those coins to a much, much lower level. So if we zoom in on the last year of price action, we can see that we've also had this diving down of the short-term holder cost basis. Note this steep decline during the sell-off itself. That is that exact behavior going on. Now note that it also tends to provide resistance all the way up. So whilst it isn't a downtrend, it's currently trading at around 28,300. And what we really are waiting to see is this continue to decline. And when the market manages to get above these levels, above that $22,000 zone, we've got all these realized prices, above that $28,000 level where we have the short-term holder realized price. These are the kind of levels that we can pay attention to really signal that a strong momentum push is starting to come back into the system and the market is starting to gain a bit of demand and strength. Until that point in time, we can really expect that these will continue to provide that overhead resistance and we may well have that duration element still ahead of us. So lastly, to close out and actually describe all of this in terms of momentum. What we have here is the market realized gradient oscillators, which is a bit of a mouthful, but what these essentially pick up is you've got the spot value, which is consider that the speculative momentum, and then you've got the realized value, which is essentially the underlying fundamental strength. So what this is measuring is how much momentum in a vertical, up or down sense does the market have, the speculative value. Higher values mean very strong speculative pushes higher relative to the actual capital inflows. So again, very, very high values mean lots of momentum. You can see here as we topped out in this particular pattern, we had declining momentum, lower highs in the oscillator, higher highs in price. What this is showing is that on a 14-day basis, on a 2-weekly time frame, we had declining momentum even though the market was making higher highs. Now, what you can see is that during this bear market, we've essentially oscillated mostly below a value of 1, which is, or a value of 0, sorry, which is signaling negative, bearish momentum. We had a couple of breaks above, but it consistently gets rejected back down below this value of 0. So the market has been in a negative regime. Now, we've poked our head above. As we broke above the realized price, we got a little bit of momentum, but really it's nothing to write home about. It kind of looks like the same momentum we've had throughout the majority of this bear, right? It doesn't look like we're getting increasing momentum to the upside. At the moment, we've got a bit of a break above. There's some positive momentum, but it hasn't yet stuck the landing. Now we have a very similar pattern showing on the 28-day. This is a little bit longer time frame. So you can see that on the short time frame, it's quite noisy. We get these false signals on a regular basis, but also it will be the first one to react to a trend. This is very typical when you look at short and long-term moving averages. So on the 28-day basis, we also have a bit of momentum, but it's also not really something to write home about. Now on the 140-day basis, this is a much, much bigger time frame. This is 10 times the first oscillator that we looked at. And what this tends to do is stay within a bullish regime for a long period of time. And when it finally breaks down below a value of 0, we really tend to shift into that regime. So this here, you can see that there was much less momentum in this second high in November than there was back here in January, February. So this really is another piece of evidence. It's a macro bearish divergence. We see this across MVRV and NUPL. There's many metrics that signal we didn't have the same momentum in that November all-time high to the one that we had back here in March, or in April, sorry, 2021. Now, the other thing to know is that this has persisted in a relatively negative form for a long time. So this is really describing this very, very low values of this oscillator is telling us the momentum has been to the downside essentially since May 2021. Now, it is gradually grinding higher. So what it's showing is that we don't have the same negative momentum that we had back here in June 2021. It is starting to compress. So we're seeing that the momentum to the downside is slowing, which kind of describes, similar to our capitulation above, momentum is starting to soften to the downside. Even though it's still bearish, it's starting to slow down a bit. Now, what we really need to wait and see is, do we get some upside momentum here? Because that would start to confirm across multiple time frames the market's seeing a bit of strength. But until that time, what this particular oscillator is suggesting is that right now momentum remains to the downside, and it really aligns with that duration element. We haven't been down here quite long enough to form that foundational bottom. We've seen a lot of the initial capitulation, but what we haven't seen is that, 3, 4, 6, maybe 12-month period. We don't know yet, but what we've seen in previous bear cycles is that multi-month period of the market digesting the bear, finally forming a bottom, and then seeing that inflow of new demand. So that's really that last piece, and we can really see it across a number of these metrics in both technical and in the on-chain space. So thanks for tuning in for that session, folks. Hopefully you found that useful. What we're looking at here is a recent uptick in Bitcoin prices. It's coming off the back of a large statistical deviation. That slingshot was pulled a little bit too far, and it has rebounded. However, what we also can see is that the longer term momentum hasn't quite recovered yet. We're still in this bottom formation pattern, and we're yet to really see that influx of demand and that shifting character. We've seen a big flush out, but what we haven't seen is the recovery phase that normally comes after that. So hopefully you found that useful, and I will see you in the next one. Cheers.